So what I'm going to show you here is the institutional level type of analysis for both futures and options. So this is used by a lot of the multi-billion-dollar firms out there. That's including the HFT shops, hedge funds, the banks, all the big operations, and how they do the analysis of futures and options. So here, I don't go deep in it, but what you're doing is essentially you're trying to assess the current market condition and then forecast from that point on. So the volatility assessment is where it goes deep. That's really important. We look at historical volatility, price action, long-term contract context. So we are looking for the risk prospective, and that's part of the crucial aspect when it comes to pricing options. We also calculating the implied volatility. We gauge the market using various inputs into option pricing models. And then from there, we can generate various implied volatility on the put side and the call side. So you get your bullish or bearish sentiment. And this is using true data, okay? This is very data driven. These are not mathematical hypotheses, right? So again, the more sophisticated, as I said, with the hedging, what we're doing here is we're formulating, evaluating. We are using typical statistical analysis, returns, variance, correlation, trying to calculate the optimal hedge ratio. We're trying to find how effective, if there's basis risk there, the difference between cash price and the future price. And then from there, we do an overall scenario analysis, trying to establish a floor price. And that protects against price declines, which still allows for potential gain.